Hello and welcome. I am Jacqueline Brewers, Deputy Portfolio Manager at Utilico Emerging Markets. 2024 looks to be yet another exciting year for the transportation sector. So let's look at one of the underlying megatrends that we are witnessing, global trade. In 2023, there are a number of macro challenges for global trade, higher interest rates and inflationary pressures, resulting in lower global demand for goods. Global trade is also affected by the ongoing destocking process, a hangover arising from COVID-19, which caused huge global supply chain disruptions. However, we have seen that the rate of destocking has started to slow in the fourth quarter of 2023, indicating that there could be a potential improvement in global exports in 2024. The outlook for exports this year is a modest increase, but still a positive move, which will be great for ports and logistic players, as this should help generate an uptick in volumes. However, there continues to be a number of multi-year global trade megatrends that we, at Utilico Emerging Markets, continue to focus on that will benefit the transportation sector in the longer term. Firstly, the continuing shift in global trade. Emerging markets as a percentage of global trade is becoming more important. By 2040, emerging markets as a percentage of global GDP will have exceeded that of developed markets. And that will be driven by increasing GDP per capita, which is helping grow the middle class, which in turn is resulting in an increase in demand for goods and services, which is then driving international trade. This will therefore lead to higher volumes handled at emerging market ports and logistic companies. International Container Terminals, a Philippines-listed container port operator, a company within Utilico Emerging Markets' top 10 holdings, is one company that is benefiting from this shift in global trade, given that the majority of its 33 terminals across 19 countries are mainly located in emerging market countries. Secondly, we are witnessing the diversification of supply chains. Manufacturers are looking to diversify their supply chains, as COVID-19 highlighted the risks associated with concentrated manufacturing locations. Companies are therefore now looking to diversify their production, as realised no longer can their manufacturing hubs be located solely in one country, as they need to diversify their country risk. Mexico, Vietnam and India are all countries that have benefited from this. Traction, a Mexican logistics company held within UEM's top 30, is an example of an investment within our portfolio that is benefiting from this diversification of supply chains, as Traction helps provide logistic and transportation services to some of the international manufacturers that are relocating to Mexico. Linked in with the diversification of supply chains and the changing landscape of trade flow is a third long-term driver of global trade: geopolitical pressures. Geopolitical pressures are changing trading behaviour between countries. For example, the ongoing US-China tensions have resulted in a number of manufacturers in China looking to diversify their supply chains away from China, so they now operate what is referred to as a C+1 model, China plus one other country. Manufacturers are looking to move manufacturing hubs closer to home. This nearshoring or friendshoring has again benefited countries like India, Mexico and Vietnam. Mexico is now the top exporter to the US, overtaking China. The geopolitical pressures arising from the Ukraine-Russian war is also having an effect on global trade. Transport Trade Services, a leading provider of integrated logistics services in the Danube Basin, another company in UEM's top 30, which helps link Central and Southern Eastern Europe to the Black Sea, helping facilitate trade flow in the region, has been well placed. The current geopolitical tension in the Middle East is also placing pressure on global trade. 30% of global container volumes are transported via the Suez Canal. If disruptions in the Red Sea continue, then routes to supply Europe from the Middle East or Asia could be materially affected, increasing shipping times and cause freight to be rolled onto later vessels, which could cause delays and congestion in some ports and hamper logistic supply chains. It is unclear at present, however, how this will play out, but it could boost storage income for some ports, but also it could affect volumes, so it is something we continue to watch very carefully. Climate-related risks are also affecting global trade and flows. Adverse weather effects are affecting agricultural output and therefore affecting global volumes. In particular, we need to watch out for the effects from El Niño. At present, the impact of El Niño can clearly be seen on the draft levels of the Panama Canal, as it's reduced from 15 metres to 13.5 metres, and this has reduced the handling capacity of the canal by half. This means fewer vessels can travel from Asia to the east coast in the US via the canal, and this is causing further disruptions and affecting flows, something we continue to watch. Overall, we think our current holdings are very well positioned to capitalise on the long-term global trade megatrend playing out. And we expect this megatrend to benefit the companies we invest in, not only via their financial performance, but also by their share price performance, which will help deliver long-term returns to UEM shareholders. For more insights into UEM and its portfolio holdings, please do visit the website at uemtrust.co.uk or follow Utilico Emerging Markets Trust on LinkedIn.